So you want to buy a bigger home, but you're stuck trying to figure out the timing of what to do with your current one. You know you're not alone. Move-up buyers face big hurdles. You know their equity might be trapped in their current home. Realtors tell you that home sale contingencies are completely off the table. And lenders warn that you might not be able to carry two mortgages at the same time because maybe your income doesn't support the debt. It can feel impossible to buy before you can sell. But don't worry, in this video, I'm gonna share proven tips and tricks to make that move smoother, cheaper, and much less stressful, even in challenging markets, and especially if you've been told you can't qualify. So let's dive in. In a perfect world, you'd sell your home first, pocket all the equity, and then close on the new home while moving directly from one house to the next. But in many markets, that's just not how it works. And as a result, move-up buyers often need to consider buying first and then selling later. This can tie up your down payment funds in the old house or lead to financing roadblocks like being told you don't qualify for a new mortgage until you sell your current home. Now, I'm gonna break down these two scenarios and give you solutions to overcome each of them. First, let's talk about the cash, specifically the equity that's in your home that you could use as a down payment if you were able to sell first. To buy a new home, you do need cash for a down payment, but it can come from many different sources. Some of you watching may have assets, but they're tied up in investments such as stocks or mutual funds. Now, one idea to leverage those funds is to use a margin line of credit. Now, this tactic is used mostly when you have assets to purchase a home, but you want to avoid all the tax implications of liquidating your investments. In most cases, you can get a margin account of, let's say, 30 to 50% of your account balance, depending on your investment portfolio mix, like how risky are your investments. You would need to speak to your investment advisor or the brokerage firm that houses all the money to get details on whether your account has that option. Now, because this is a loan, interest is charged. Most tend to be interest-only loans, and the rate's usually tied to prime rate. As an example, that might be something like a payment of $625 per month for every $100,000 you finance using an interest rate of 7.5%. But what if you don't have an investment account, or maybe that account doesn't have the ability to have a margin account? Another solution would be to use a 401k loan. Most 401k providers allow you to borrow the lesser of up to 50% of your vested balance or $50,000. Now, this too is a loan. However, the interest you pay goes back into your 401k account. You're essentially borrowing from yourself and paying yourself back with interest. Now, there is one risk to this approach. You could lose significant market returns between when you take the loan and when you finally pay it back, if the market, let's say, jumps or rises. While it might not seem like much in the short term, the compounding impact can be many, many thousands of dollars when you retire. Now, on the flip side, you could look like a genius if you took the money out at the market peak, say February of 2025, and then paid that money back after the crash. Now, one other thing to keep in mind, if you change jobs and you have a 401k loan, you have just 60 days to pay that loan back in full, or you'll be taxed and you'll have an early withdrawal penalty. Now, let's say you're equity rich and those other two options just don't exist for you. Like, what else could you do? Now, the most common and least expensive solution is asking family for a gift. Now, I know it feels weird to ask mom, dad, or grandma for money, but you never know. They may be thrilled to help. So let's say that's not an option, and you can only rely on yourself and the equity in your home. Don't worry, you're actually still in luck. There are two methods used to extract equity from your current home: a home equity line of credit, or a HELOC, and a bridge loan. A HELOC is like a flexible credit card tied to the value of your home. It lets you borrow money up to a limit based on your home's equity, and you only pay interest when you actually borrow the money, not the whole amount. The interest rate is typically tied to the Fed's prime rate, and payments are typically interest only, giving you a little budget relief. The issue with HELOCs is that you can't get them once you're under contract for a new home. Why? Because most HELOCs are for owner-occupied transactions. Like, you're gonna live in the house while you're borrowing the money. And once you commit to buying a new home, your old house is no longer considered your owner-occupied home. If you choose this path as a solution, you need to be a little proactive. You need to open this HELOC sooner rather than later. Now, these loans do have some closing costs. Some can be waived if you keep the loan long enough, but it's usually, let's say, around $1,000 to $2,000. But this is generally far better than the next solution, which is a bridge loan. A bridge loan is temporary financing given to a borrower to use really in any capacity to help them buy a new property. The lender in this case knows it is a short-term loan, so you can close these very quickly and after you're under contract on your new house. The issue with this approach is the cost. I call bridge loans the loan of last resort because it's the most expensive option. However, sometimes it's the only option. Now, for more information on bridge loans, check out the video I linked above where I did a much deeper dive on all the various uses. Those are the common tactics used to address the cash or the down payment side of the equation. But what if you're being told you can't qualify for the new house? A lender told you cash isn't the problem, your debt and your income is. You just don't have enough income to carry 2 mortgages at the same time. But don't worry, we have solutions for that scenario as well. And before I begin, if you found value in this video, please be sure to hit like and subscribe to this channel, or better yet, forward this video to any friends or family you have that's considering moving up, as they might find this information very helpful. Now, when you're told you don't qualify, one of the solutions to use is a bridge purchase loan. This is a short-term loan given using common sense underwriting. And by common sense, I mean they map out the likely outcome to provide financing based on whether that's possible. For example, let's say you have a $750,000 house to sell, and you have a $400,000 mortgage and maybe a car loan for 30 grand, and then maybe some credit cards totaling about $15,000. Your plan was to sell that house, pay off all the debt, and put $250,000 down on a $1.2 million home. The bridge loan lender would look at the end scenario and qualify that person on a $1 million mortgage with no other debt. And if they qualified for that scenario, they would provide financing to close that deal. And maybe you use a bridge refinance on the old house to pull out equity for the down payment on the new one. Or maybe you already have a HELOC, or grandma gave you a gift, or maybe you use that margin account. There are many different outcomes. And as you can see, these solutions can be stacked on top of each other to help you get into that new home. While these bridge loans are very flexible, they are quite expensive. If you didn't like the cost and you felt confident that your home would sell relatively quickly, you could use what I think is the single smartest program in the industry today. And it's called the Guaranteed Backup Offer. There's a rule in mortgage lending that allows a lender to completely ignore all the debts associated with your current home. That means your mortgage, a HELOC, a bridge loan, taxes, insurance, your HOA dues, all of it. If you have a ratified contract for sale with no contingencies, essentially a cash offer. Now, what makes this approach unique is that the cost in most cases is just $2,500. That's right, $2,500. You could get a cash offer on your home, omit all the associated debts, and easily qualify for your new mortgage. I'm sure you've heard people say, when things sound too good to be true, they usually are. Right? So what's the real story about this program? Well, the cash buyer that we're talking about, they're not gonna pay top dollar, right? It's gonna be some percentage of the overall value. So you do need to have some equity. They will give you 120 days from the date of signing that contract with you to sell your house. That's why they call it a backup offer. If you can't sell your house, they will buy it from you at the agreed upon price. But they really don't want to keep your house, right? That's not why they're doing this. So they're going to put that house right back on the market using a realtor that you choose, and they're going to give you 90% of the profit when they sell it. So let's be clear, there is risk with this approach, but the financial backstops they give can offset a lot of the concerns that people have. Now, we just discussed a few ways that you can try buying a home before selling your current one, but keep in mind that lending rules exist for a reason. If you can't qualify for a loan, you should think twice about utilizing all these options. Proper risk analysis is the key to long-term financial success. So there you have it. I hope you found these tips and tricks for moving up into your new home helpful. Subscribe to the channel if you haven't already, as I'll continue to push out content to make sure that you are the most financially responsible homeowner that you can be. I look forward to seeing you in the next video.